Good afternoon, everyone. Thank you so much for joining us today. My name is Megan Lanuette. I'm the VP of Marketing and Business Development here at First World Mortgage. And I am joined today by my colleague, Scott Stoll. He is the Vice President, Senior Loan Consultant here at First World Mortgage, and he is the branch manager of our Glastonbury location. He's been a mortgage loan officer for over 25 years, and he's ranked among Connecticut's 5-star mortgage professionals. I'm also joined today by Jenny Bergeron. Jenny is the founding member of Athene Wealth Management here in Glastonbury, and she joined LPL Financial and created Athene Wealth Management to serve business owners and individuals that appreciate the white glove and high-level service approach to create and manage their financial life. So she's an award-winning wealth manager and happens to be one of my favorite people. So without further ado, I will send it on over to her to kick things off.
Great. So thanks for your kind words. And while we're both 5 stars, Scott, I rate higher. So thank you, Megan.
Hey, okay. Thank you. And
So
I agree. Thank you, Megan.
we wanted to put this on because, over time with what we both do in the mortgage and in the investment world, but especially with COVID, more than ever, people are stressed out about making purchases or planning on making changes. So you really need to know your numbers. And when I say know your numbers, be happy, I put be happy because so many people, regardless of their station in life, are afraid that if they know their numbers, they're not going to like what they see. And that's not necessarily the case. So a large component of my work with my clients is helping them carry healthy debt, and if necessary, readjusting their finances so they are ready to make those larger milestone purchases, which is always going to be how managing excess spending and knowing the numbers. So, life should still be fun. I always tell people you still want to do things in life and feel like you can go out for that steak dinner or on that vacation if that's your thing. But purchasing things like homes and going on trips when you want to is much easier when you plan for it. So if you think you're the only one that's stretched or you worry about making intelligent financial decisions, I can assure you this is not the case. Think again. And again, in my experience, whether you're working with someone that has a high net worth and has a lot of, relatively speaking, a lot of money in their portfolio, their challenges and their desires and their concerns are the same as the person who is literally just starting out with their first real job from college. The numbers are just different. It's relative. So especially now, the future is not canceled. Your opportunities are not canceled, regardless of what life is throwing at you. Just know that if you plan, you can much easier bob and weave the little slings and arrows of life so that you're prepared to handle what's coming your way. So again, I can assure you that while knowing your numbers isn't always sexy, you'll feel much better when you do. So let's talk about debt, and there's many forms that it comes in. So, the right way to use debt. So things like mortgages and lines of credit, auto financing, those are called installment debt. Things like student loans, small business loans, those are also referred to as installment debt. And when you look at a student loan or a small business loan, student loans in particular get a bad rap, but they're really an investment in your future, just like a mortgage is a piece of equity. So you really have to stop worrying about that. It'll just make for a much more enjoyable life. What do we mean by installment debt? So basically you're paying a portion of the total due at regular intervals over a given period. So it helps you get what you need when you need it over time. One of the things that I do see for people, which is a big stumbling block, is they try to pay down all of their debt quickly. And when you do that, you can then restrict your cash flow and you start to carry unhealthy debt, which we refer to as credit card debt. And that becomes counterproductive right away. So, credit cards, there are little plastic traps. The interest rate, if you don't know the interest rate on each of your credit cards, you really should find that out. You can look on your statement, you can go online. If you're the type of person that just likes to call, flip the card over, call the 1-800 number and find out your rate. Because knowing your interest rate is going to help you realize how much it's costing you to use that money. There was a recent study by Wallet Hub, and the average APR for people with fair credit is 23.43%. That's high. So again, it depends on your credit. And many credit card companies offer lower rates for an introductory period, but it's very easy to get a credit card, have that lower rate, and then forget about it, and then your interest rate is jacked up. And credit card companies will count on you not being able to pay off the debt right away, so then it's stretched out. So make it a point to know your interest rate. Scott, did you want to talk about debt a little bit?
Well, yeah, I was just going to talk to you about, you mentioned healthy debt. And it's a good point because throughout your life, whether you buy a house or a car or you're doing investments, it all comes down to your credit and the debt you have within your credit. And healthy debt is a good thing. And what I mean by that is, you should have 2 or 3 credit cards, just not maxed out, maybe keep the balances low, making the payments. You don't need 12 credit cards. You don't need 10 credit cards, or every time they're offering 20% down, you open up a new credit card. Have healthy debt, make sure you make your payments, because when it comes time to do the important things in life, like open up investments for retirement or buy a car or the biggest purchase, a home, it's going to make a big difference on your interest rate and your ability to be able to afford the home or place you want to live in with your family. So healthy debt is really important, and it's good to get a free consultation, whether it be through Jenny or myself, and we look at your debt and we put something together where you can be happy, so it prepares you for that big purchase or events in your life.
Right. And, I included, there's a recent survey, and this actually went down from the year before, but NerdWallet does a survey. It's an American household credit card debt survey. And at the end of 2019, the average household owed about $7,100 in credit card debt. That was about $16,000 the year before. So in my business, we're always looking at, numbers, and we're always looking at what's going on with the consumer and businesses. And if you've heard in the headlines that people have saved money throughout the bull market, it was true, and it was nice to see it in the actual numbers. The other reason why I wanted to include this slide is, people will always say, oh, I have so much credit card debt. Well, if you don't have $7,000, you're ahead of the game, in the sense that you shouldn't, feel so badly about it, because again, a lot of this is psychological. So there is a calculation for debt to income ratio that you might already be familiar with. And they use this certainly when you go for a mortgage. Scott, did you want to talk a little bit about debt to income ratio and what your suggestions would be?
Well, when you're getting a mortgage, they look at your minimum payments. Being a car loan, your minimum, say your car loan's $500, and then say you have 3 credit cards, that the minimum payments are $50 each. So that's $150 there. So what they're doing is they're taking your gross income and the amount of minimum payments debt you have, and that calculates your debt to income ratio. You always want the lower debt to income ratio when you buy a house. And a lot of times I see clients, they make their payments on time, they're never late, but they don't have that healthy debt. So their debt to income ratio is high, sometimes too high to even get a mortgage. And their biggest complaint is, well, I've never missed a payment, I always pay on time, but they just have too much debt. So keep those payments at a lower base and have that healthy debt, and you're gonna have a low debt to income ratio. So when it comes to buying a house or even getting a car or anything in life, you're gonna be able to do it. Does that make kind of sense?
It does. And we'll have similar conversations with people because we're not just managing their investments or doing their retirement planning or, planning how they're going to pay for their kids' education. Those are the 2 main things we work on. But, that process, that diligence process is, I'll hear people talk about that. Well, I want to refi. and I think I'm going to have trouble because, you know, we had a couple of things happen with the house and we have a lot of credit card debt, and that's where I'll hand them off to someone like you, a mortgage broker.
Right.
One of the big things you can do is, you know, put debt into perspective, right? We did that. But what would happen if you had money in the bank? This is another stumbling block that I see people fall into. Everybody hears about a rainy day fund. So, you know, the basic rule of thumb for a healthy working person working full time is 4 to 6 months of expenses, not income, but expenses, right? So people will really want to have a rainy day or an emergency fund, which is absolutely super important. That is often difficult when you're in what I call your mountain phase. So your mountain phase is when you're working and you're just started a family, you're either in a home or you're planning on buying a home. And so what people will do is, let's say they have 10 grand in the bank, but then they're using their credit cards because they don't want to take the money out of the bank, which I appreciate that. I respect that. But if you look at the slide and you look at it from a numbers perspective, let's just say you have, you know, money in the bank and, you know, 1% interest in the bank, you know, nobody's really getting that today, but we'll just use that as a good round number. So if you have money in your savings account and it's giving you $1 essentially, 1%, but you've got $1,000 on a credit card and it's 18% interest, you're in the hole $180 if you're carrying that credit card debt, and you're only up $1 if you're keeping the money in the bank. So you're at a, you know, a loss of $179. But if you use your savings to pay debt, even though it's scary and you can actually see people's face get white and like the color drains out of their face, they say, oh, you know, I don't want to take money out of the bank. But if you pay off your credit card, you know, debt, let's again use $1,000 over on the right, you have zero, you've spent an interest. Yeah, you've made zero money and you've taken money out of the bank, but basically it's a wash. So, you know, we'll talk about this a little later on about the psychology of debt, but it's really important to think about it, you know, that way. Another option is you could take a low interest loan to pay off your debt. And usually I work in conjunction with your tax advisor to do that, to see if that's an appropriate situation. Scott?
In regards to what, taking a small loan out against you to pay off
Or
debt?
just debt, you know, just debt in general, what you see about paying off debt, you know, really taking care of your credit cards and having a healthy attitude with your credit cards, because you deal with that a lot, I'm sure.
Yeah, my biggest issue, I mean, it's not my issue, but I see a lot of folks that are maxed out on their credit cards. And even though, just to give you an idea, if you have two people, same exact credit cards, same limits, $10,000 limits. One person's maxed out, never missed a payment in their life. The other person has low balances, under 40%, so under 4,000. That person's going to have a lot higher credit than the person that is maxed out. And you say, well, what's the big deal? I'm making my payments. Well, because there goes that rainy day now. Now, if there is a rainy day or something happens and you get, you know, maybe get laid off for a couple of weeks, you have available cash in that credit to live. All right. Now, as far as your assets, I mean, we see a lot of people right now, especially doing cash out refinances to consolidate their debt because they just got into such bad problems, you know, with 4 credit cards and it totals $40,000. There's just no way out. They don't see the window that they can even get close to paying them off. Yeah. So that's why it's really important to, you know, keep your debt low. That I'm interested in hearing more about what you said about the, you know, taking money out of your bank, because that's interesting, and I do feel that people should do that as well. You know, pay off your debt. If they can't pay off their debt, make sure you keep your balances low. Just pay the balances down to under 40%. Yeah. Or have a game plan. You know, you have $1,000, maybe take 2 months to pay it off.
40% is a good rule of thumb. Actually, I had never used that as a calculation, but that's a very good rule of thumb that I can use with my clients now. If we go to the next slide, so we just have a few other tips for paying down debt. And again, it's a psychology. It's going to take a couple of months to get into this habit. You know, definitely pay a set amount each month. And sometimes you have to pay the minimum, and that's okay. Sometimes I'll say to my clients, pay your minimum so that way you have some cash flow so you're not in that catch-22. That shouldn't last forever. That's just to get you off, because what will happen is people will say, okay, I'm going to put $1,000 on it. The minimum might be $300, but then they have no money to go to the grocery store, right? So it's a vicious cycle. So pay a set amount, and even if you could do $100 over the minimum, yay, right? So besides that, a good rule of thumb is the minimum, any new purchases, and the interest for the period. So not the interest for the year, but your statement, whether it's online or paper, is going to say interest for the period. So maybe your minimum is 100, you made a $60 purchase, and then your interest is $10, so $170, right? So now you're paying a little bit more, but there's a logic to it, okay? You can start with the highest interest rate card by, so let's say you have 3 cards and you can't afford to pay extra on all 3 at the same time. Well, choose the highest interest rate card because that's costing you the most. Or if you have a credit card that only has a little bit of money that you owe on it, maybe $300, and you can get that paid off in 1 or 2 payments, you can use that psychology. But typically we go to the highest interest rate first. Be realistic. Don't say you're going to do $1,500 a month if it's not something that's doable. Small steps equal big gains. Readjust if you need to. Do not get into that, oh, woe was me, and then you have to go out and make an emotional purchase or go for, a spa day, which is going to cost you $800 because you're stressed out, right? I'm a big one of spa days, and I don't need an excuse. And again, when you finish paying off one of your cards, let's say you were paying $200 on that, add that $200 that you were paying on it. Or if you're done paying off your automobile, let's say that was a $400 payment. Now, instead of, paying that going out, which we're all for going out, but now take that $400 you were paying on your car and use that to pay down your credit card debt. Are there any other tips that you give your clients, Scott, for paying down debt?
Well, the main thing is, I was just going to tell you, is you got to have a game plan. Like you said, I mean, you can't just go in it and say, I'm just going to throw 20 this month, 50 this month, 100 this month. I always suggest take the ones with the highest interest rates as well. Also the ones with the highest balances. Like I said, when you're maxed out, even if you can afford to get it down to 70%, that 70%, like loan to value right there, is definitely going to help your credit scores, as well as you having the ability to borrow some more if you needed it on a rainy day.
Right.
Then maybe the next month or 2 months, chunk it down to 50%. So you got to have a game plan of what you're going to do. And it's hard because, we're in this world that instant gratification, everybody wants. And when they pay their car off, a $500 car payment, and then they're saying, well, I have $500 free. And then what they do, they still go charge up on their credit card, but then they don't pay that $500 a month, they pay $200. So you got to have that game plan. And if you do, it's amazing how quick the cards will go down. Right.
And I think, I'll also mention that, we're big personalities. Scott and I are big personalities. So we're like, but just realize that we're here to help. And, we don't sit on a pedestal and, we're not judgy or, just realize that when we talk about having a game plan, it's because we see that it works. And we're here with you all the way because we are consumers. It's over 70% of our gross domestic product, which if that's a good number, it's going to measure the health of the economy. Yay. And it's going to help the market. So we are consumers and we applaud that, right? But let's be intelligent about it. How empowering. So just some things about being a smart shopper. And again, this is psychology. So you want to live, you want to enjoy your life, but you really, if you have debt, you want to reflect on your purchases. And the best way to do that is to only use cash. So what do I mean by that? I don't carry cash. It drives my husband crazy. I carry a debit card. So when I say use cash, it means use real money. So if I go to the store and I want to buy a new handbag. And that handbag, and no, I don't do this, Gary, that's my husband. If my new handbag is going to be $1,000 and in the bank I only have 500, I do not buy that handbag, because it's a psychology, because then it's going to go on the credit card and it's very easy to not pay that off. So when you start to think about money's not in the bank, I'm not going to use it, that will get you to the road of having healthy spending habits. Credit cards, you can have 18. I really don't care. Keep one in your wallet. So just keep one for emergencies. Always consider your priorities. I think if you're a conscious human being, you're going to do that. And if you feel you need to, explain the need for your purchases. What's really interesting is there's a lot of studies about wants and needs. Really, we have everything we need. Shelter, clothing, things to keep us clean and healthy. Everybody's got money for a mask, hopefully, right? So, you can actually, it sounds really silly and rudimentary, but if you've had some issues that you feel are keeping you from getting a mortgage and buying a home, really go down to that basic level. And,
Jenny, it's funny you said,
Well,
you said, oh, sorry. You
I'm
said
done.
that because I just recently started carrying cash, because only for the miscellaneous items, like the little things, lunch or coffee or things like that, because I always used my debit card. And then, I use my debit card for like a big purchase that I need, because I can plan for it. But I started last year writing everything I spend each month.
I do too. I keep an Excel spreadsheet, so make fun of me
and it really
now.
got me nervous, and that's why I did it, because it's it's like you swipe your card, swipe your card, swipe your card. But as I started carrying cash, I started second guessing some purchases. I'd be like, well, I have $300 on me, and then at the end of the week I might have 150. I'm like, well, wow, what did I spend? And then that might make me think a lot of things differently. But it's tough. But once you get in a routine, it's amazing how you look back at the months that you spent a lot. And the newer months, it's like, wow, I saved $1,000 this month.
Right. And to translate that, so in your world, it's so people can more easily get into a mortgage, get the home they want, not be stressed. In my world, it's part of that, but then it's so that way you can go to Florida for 6 months out of the year if that's what you want, or do a trip a year with your grandkids, either before or when you're retired. So it's having that plan.
Correct.
So, yeah.
I think it builds this has been a great message also, because times like what we're going through has people thinking about their priorities, right? And it's a shame when it has to be this way, but it often causes us to reflect on how we're spending what we're spending on. And unfortunately for some, they're put in a different financial situation, whether that be because of employment or because of the added costs of bills or what have you. So regardless of what brought us here, it's important to think about what your future possible purchases are, but just in general, how you can manage your pocket and make it last, build a little buffer for yourself and allow yourself to live more freely, because you feel more in control of what you're able to do with what you've earned and what you have. So,
it's like, the society makes it so easy. Internet. I mean, with Amazon, you're sitting watching TV and you can easily buy things you need to say, did I really need that second pair of sneakers, or do I really need this, 50 phone cords that I just ordered? But, and then you realize your bill comes and it's a couple $100. So, internet makes it really easy and hard at the same time to stay on track.
Right.
One thing I wanted to make sure that you both addressed kind of before we go is one question that came ahead of this. A lot of people go to stores and they open up, their Old Navy card or their Kohl's card or what have you. Can either or both of you speak to those sorts of lines of credit, and kind of are there these like micro levels of priority in terms of having certain cards, or how would you address those in the context of this conversation?
Scott?
Well, I always tell my clients there's different tiers of credit. Mortgages, top tier. Okay, never be late on your mortgage. Always pay on time. Never be late. The next tier is basically any loans, personal loans, car loans, student loans. That's a high tier. Never be late. Those are things you can't control. The payments, the payment is what it is. You can't control it. You got to pay it. Then you got the revolving debt, your credit cards. That's where you got to be cautious, because you can change 1 month. You can only have one credit card. In 3 months, you can have 10 with $100,000 worth of credit out there able to spend. So that's where it comes down to what we spoke earlier, healthy credit, healthy debt. Don't be maxed out on all your cards. Use it sensibly and be able to pay extra. You have a game plan. If you do put $1,500 on a credit card, because that's what they're there for. If you have a dishwasher or a fridge that you need and you can't afford to go out and spend $3,500, and if the store doesn't offer interest free, you got to put it on your credit card if you can't take it out of your bank. Well, just don't pay the minimum. Have a game plan. If it costs $3,000, what can I do to pay that off in 6 months? And that's your plan, and stick to it before you start adding more things to that card. So those are the tiers that I tell my clients is mortgages, never be late. Loans, student loans, car loans, you can never be late on those. But those revolving debts, the credit cards, is where you got to be cautious, and you should really have that game plan on those payments. I don't know if Jenny, if you agree.
Yeah, and I have a question for you, Scott. So what about because I get this question periodically. Someone has 3 credit cards, and what they want to do is that it's not that they want more credit cards, but they never use one of their cards, and they want to get a new one, say, that will give them airline points. But they're afraid to cancel one of their credit cards, even if they're replacing it with another, because closing cards has historically been bad for your credit. What would you say to someone in that instance?
I would say as long as you're not going out buying a house within the next couple months, because
it really matters that much.
Well, it does, because, just to say you're getting ready to get pre-approved for a home, and last month you opened up a JetBlue credit card or a Southwest credit card just to get the miles, because everybody's doing it. And then you say, I'm going to close my Chase card, and I don't mean to pick on different banks, but when you close that card, pay it off and close it, it's going to affect your credit in a negative way. It's not going to affect it huge. So say you're 750, it might bring it down to a 730, or it could bring it down a little more. But within 30 days, it's going to go right back up.
Right.
So it's not a long-term, deduction on your credit scores. It's going to go back up.
Good to know.
That's why I tell people, try not opening up any new credit cards or do any layaway purchases, or, get these cards just because you're buying a house during the transaction. If you're not going to buy a house until September, do all that stuff right now, because come August, we're going to see, and your scores will still be right back up where they should be.
Good. Thanks.
That's another good point. Just before we go, during the lending process, I know there's certain things that we absolutely don't want people to be doing. Can you quickly outline that before we go, Scott? Because that's always a good thing to kind of run through.
Basically what I just said, do not open up any new accounts. No layaways, say you're buying a couch and you're going to put something on layaway and they have to pull your credit. You want to keep your credit pulls to a limit. So you don't want a lot of people pulling your credit. Any big purchases, you want to tell your loan officer or loan consultant, hey, I'm thinking about buying a car. Is this going to affect me? So you don't want any big purchases, and no cash deposits. So anybody that has mattress money, that's old school, that has, like their grandpa had $5,000 cash in a box underneath their bed, you can't just deposit those things. Talk to the lender before you think about buying a house, and they'll tell you, you got to deposit it, and it's got to sit in your account for either 60 or 30 days before you can even, start your process. So there are things like that that people don't know, and it happens all the time. We'll talk to somebody, they're putting an offer in tomorrow, and they said, I have a box of money that for my rainy day, right, Jenny? Rainy day fund, $10,000.
I always tell people, I don't care if it's under the bed or in a mason jar. What do you have for a rainy day fund? Because it's true, but go ahead.
Right. And, and cash is good to have for a rainy day fund. I mean, I think it's a good thing to have because you never know when you need it. But when you buy a house, you can't just throw the cash into a bank and have a lender source it. So, no large deposits, no cash deposits, no credit pulls, not a lot of them. And just try not to open up a lot of credit cards or big purchases. Those are the main things when you're buying a house.
And some lasting final thoughts from you, Jenny, before we close out?
No, I think we've covered, a lot of it. One of the things that, of course, with what we've been through, it causes you to be very reflective, not only for yourself, but for your business. And especially for me, because I consider my clients my flock. I mean, when all this started happening with the market before COVID, even we got into lockdowns, my first priority was making sure they were okay. And the funny thing was, I wasn't getting any phone calls, and I started to wonder what was wrong. And I realized it wasn't what was wrong, it was what was right. And it was a blessing because it's the process and having the plan, like Scott was saying, which sometimes I know I annoy my clients, probably the ones who aren't really ready for the plan, but I'm like, no, this is what we're going to do. But that the upshot was, it was like water rolling off a duck's back for people, essentially, when it came to investments or their long-term plan, even for my clients that were in retirement. So, I was thankful. So
and your clients can call you anytime, right?
Oh,
so that makes it wonderful. They don't get front desk person that transfers it to this person that goes to this person. They go to you.
So my business, I'm with a huge company, LPL Financial, but I purposefully keep my business what I call a boutique practice. It's me. I'm backed by hundreds of people at home office, maybe thousands, and all my vendors and product partners that truly care about my business, and my office manager, and that's it. That said, if I'm on vacation and someone can't reach me or I fall off a cliff, there's certainly people at home office to help my clients. But no, I purposefully keep it a very intimate practice.
I think you've answered the phone for a few clients that when you were away, haven't you?
Yes, I have, because if I'm sitting on, did you call me in Aruba? Someone called me in Aruba. Was it you? No, if it's someone that I know is just going to ask me a question and I'm on a beach, what difference does it make? If I can't answer the call, I'm not going to answer it,
Well, I got a surprise guest, guys.
Who?
Jenny, your husband's here. Something about a purse purchase in cash. He said he's going to go away. He's going to come see you right now.
Awesome.
Well, this was hopefully extremely helpful and constructive for those who are able to tune in. Thanks for joining us.
Thanks,
both
everybody.
Scott and Jenny, they're readily available, even when in Aruba, in most cases, unless they're in the water, to answer questions, curiosities, concerns you have. You have all their contact info up on the screen there. Don't be afraid to get in touch with them. I can vouch for both of them that they always answer their phones if they are able. So in the meantime, we appreciate your time, and hopefully you feel a little bit more empowered with regard to your financial decision making going forward. So thanks again, and have a great day.
Thanks, Megan.
Thanks, Megan. Thanks, everybody.